Take it away, hosts.
Good morning, everybody, and welcome to the Open on Public Live. Today is Friday, April 8th. We made it through the week, TGIF, and I'm your host, Anne Berry, on this last trading day of the first set of trading sessions in April. The markets move faster to help you start your day with the latest financial news. We're bringing you the Open, 15 minutes of the top headlines every weekday morning. Let's get right into it. Stock futures are mixed heading into the final trading session of the week, with the Nasdaq turning negative. Despite the rebound yesterday, markets are still on track for a weekly loss. This would be the first weekly losses for the Nasdaq and S&P 500 in 4 weeks. Defensive sectors have outperformed this week, with healthcare and staples leading the way. The worst sectors this week have been tech and consumer discretionary. The sell-off in these sectors and across the market sparked by the Federal Reserve's plan to tighten monetary policy more aggressively. The central bank released minutes from its March meeting, which revealed plans to reduce its balance sheet by around $95 billion. Officials also indicated one or more 50 basis point interest rate hikes could be in the cards as policymakers emphasize their commitment to battle inflation. On Thursday, Fed official James Bullard said the central bank is behind the curve on its mission to control inflation and will likely need to act forcefully. And in the bond market, we saw a reaction with the 10-year yield hitting 3-year highs as the market responded to these comments and has risen for 6 straight sessions at this point. And then just before we go to our guest folks, one interesting development in the travel space. I know we are all chomping at the bit to get back out there and move around a bit, but Spirit Airlines has said it will begin talks with JetBlue about its rival's $3.6 billion takeover bid. Spirit had agreed earlier this year to be taken over by Frontier Airlines parent Frontier Group, but said that JetBlue offer could lead to a better proposal. So we will see what happens there. Lots of regulatory focus on this one, but perhaps looking at a shake-up in the travel space. So let's welcome in our guest, Thomas Hayes, Chairman and Managing Member at Great Hill Capital. Thomas, welcome. Thanks for joining this morning.
Thanks for having me, Anne. Glad to be here.
So the weakness in the stock market earlier this week, a result of the Federal Reserve's more aggressive tone. What was your reaction?
Yeah, and I think the weakness that you saw midweek going into the Fed minutes was another instance of sell the rumor, buy the news. This was actually not a surprise in that Jay Powell had already signaled at the last press conference that balance sheet reduction would begin as early as May. Now we know that it will begin in May, and now that it's been quantified to $95 billion cap, they're going to phase up to that cap over 3 months, $60 billion of treasuries, $35 billion of mortgage-backed securities. We have a little bit more clarity. We also saw that the Fed Fund Futures is now pricing in a 50 basis point hike. It's got 80.5% probability of a 50 basis point hike in May. So a lot of this was known, and I think it created a buy opportunity. You know, the bad news is the 210 spread inverted over the past week, and that's a pretty darn good indicator of a recession over the next 18 to 24 months. The good news, Anne, is that the markets can still work to new highs in coming months, and often the steepest part of the rally happens after the inversion, not before the inversion. So I think there's a lot to do here.
Tom, we saw the 10-year yield hitting 2.7%, the highest in 3 years. It's not just about the level of rates, it's also, to your point, what the yield curve looks like. What are your thoughts now on the possibility of a near-term recession?
Yeah, so I think that the recession, there's a decent probability of a recession in mid to late 2023, and I think it's going to be relatively shallow. If you look at the 10-year yield today, you have to put in perspective. People feel like it's been going up so aggressively, and that's certainly the case off a very low base. But at 271 today, if you look in October of 2018, the 10-year yield peaked at 325. In January of 2014, the 10-year yield peaked at 303, and we did just fine during those periods. So this is not abnormal. But as I said, while we potentially will have a recession, there's a tremendous amount to do now. Why? It is because just as stimulus we saw in the pandemic, stimulus works on a lagged basis. It takes 6 to 12 months to be felt in the economy. The same is also true with tightening. So we're not going to feel that in the economy to mid to late next year. And if you look since 1900, there have been 28 instances where the yield curve has inverted. 22 of these episodes of recession has followed, and the lag between the date of inversion and the start of the recession has averaged about 22 months. That's 122 years of data. Now, if you go a little more recently, since 1977, there have been 8 yield curve inversions of the 210 spread. The S&P 500's average return in the following year was 11.5%. If you add in dividends, you're talking 15.2% returns after the inversions. Inversions are not a signal to fade stocks or short the market. In effect, they're the opposite. In the short term, you can buy stocks. And the last 4 times that the 210 spread inverted shows the S&P rallied for another 17 months after inversion and gained on average 28.8% until the ultimate peak. So we think there's things to do here. You know, a lot of people are talking about the 10-year, 3-month spread. Well, that's steep. I think, you know, if you look back and you can just simply look on a chart, it's less useful as an indicator, despite what the San Francisco Fed study has said. So I think we might have to bear that, but I do think it's going to be shallow because, as you're seeing, they are doing the right thing, using the balance sheet reduction and maybe keeping the hikes a little bit more modest and a little bit more tempered will re-steepen the curve, incentivize banks to keep the credit spigots on, and you may see an instance like 1994 where they did manage a perfect soft landing. It's not the highest probability bet, but I think any recession you see now with the curve re-steepening in the last few days, now 15 basis points wide after inverting by 6 basis points, is an opportunity.
So Tom, last question for you, because you sound overall pretty bullish that there are going to be ways to benefit from this inversion over the longer term. Which sectors are you most bullish on? I know you spend a lot of time on healthcare and biotech. So real quick, what are you looking at there?
Yeah, biotech is an unbelievable opportunity here. It's the sector, or you can look at the ETF XBI, down about 50% over the last year, largely on interest rate fears. It got a little crazy with the IPOs during the pandemic, so a little bit too much supply. But if you look at historic multiples since 1986, just to get back to the average price to book ratio, the sector will have to appreciate 24%. To get to the average price to operating cash flow multiple, it'll have to appreciate 155%. And just to get back to its normalized forward PE, it'll be up 112%. The two key catalysts, obviously, with COVID winding down, you're getting a lot more doctor visits, screenings, and scripts being written. The salespeople are back on the road pressing palms and steak dinners with those doctors. That's a good thing. And you've got a huge M&A catalyst. A lot of there's $500 billion of cash on the balance sheet of the Russell 3000 healthcare companies. With Big Pharma losing a lot of their patents on blockbuster drugs, they're going to have to buy innovation, and they can do so with all that cash. And they're going to do so from the biotech sector.
Thomas Hayes, Chairman and Managing Member at Great Hill Capital, thank you for joining. We have